Good morning, everybody. Welcome to this weekend update for the 6th of July. Last week, I provided quite a bit of detail about a roadmap, how things were likely to unfold over the next 5 to 10 years on a big picture level. And then I drilled down and identified some of the sectors that were either in existing bull markets that look set to continue for a considerable period of time, and also some new bull markets as well, which look really poised to kick off. But whichever way you look, if you get really focused on the opportunities that are opening up, the next 5 to 10 years, in fact, really any time period you want to look at in the next 10 years, if you're focused on the right sectors, is a fantastic time to be making money. So let me go through what actually happened last week. There wasn't a lot of change to the trends that have been going on, to be honest. The US market kept charging up. Our market went down a bit initially in the start of the week and then rebounded towards the end of the week, finally showing some better signs. It was a shortened session in America. It was only 3.5 sessions last week with the Independence Day holidays, so some of the volumes were down, but nevertheless, the price trends remain really robust. So the S&P index ended up gaining 25 points on the week. And as you'll see in the chart in a minute, the trend is as strong as ever. But, and certainly this is only short term because my view remains very bullish on certain sectors and attacked in a certain way. However, in the short term, the S&P index is as extended above the mean as it ever gets. So we really do need and should get some sort of short-term profit taking because people are just making so much money. There's going to be the temptation to start taking some of it off the table. Now, as you'll also see, the NASDAQ and Russell 2000 indices are just as strong as they've been for months, and they would be sectors that would be starting to show some signs of weakness if we were going to see anything other than just a normal bit of profit taking. So still a great deal of strength there. I'll just show this slide on the Aussie stocks and then we'll look at some charts. The ASX 200 index ended up higher by 80 points for the week, and it was really quite a good finish. It dipped early in the week, but then surged on iron ore prices that were improving, some better data out of China, and also the RBA comments with respect to the value of the dollar and the possibility of them actually lowering interest rates further. So the market took all that pretty well, and finally the Australian market did something a little bit more positive. So let's go over and have a look at the charts. This is the S&P index, and you can see that it just keeps charging on. It rose every session last week and finished particularly strongly on Thursday, closing on the highs. So if we pan back, you can see it's been a staggeringly strong bull market. If you look at the red 150-day moving average line, there is no sign of weakness there at all, and the index is as far above that moving average as it ever gets. And we saw back here in January of this year and then again in April, you do get little bursts of profit taking that last anywhere from a week to 2 weeks. And I think that's got to be highly likely again. You can see the RSI is quite overbought now. But then again, the last time it was up there, the market only pulled back for 2 days. So we'll just have to play it by ear, but I would certainly keep some cash up your sleeve. Turning now to the NASDAQ index. Again, you can see a real acceleration in the NASDAQ index, really taken off in the last week. And it also is as far above the moving average as it pretty much ever gets. And finally, let's look at the Russell 2000. Now, whilst it's lower, it is certainly recovering more strongly. So there was more of a shakeout in the Russell 2000 during March and April, and it hasn't regained its all-time highs as the other indexes have, but you can see over the last month or so it's been particularly strong. So no real signs of weakness anywhere. Let's move now to the ASX 200. It's a completely different looking chart to to the American index, as you can see, the 150-day moving average is pretty much flattened out. And it was only the last 3 days of last week where we saw any kind of positive trading at all. So other than those couple of days, our market remains a bit like a wet rag at the moment, and there's certainly far better opportunities and far better momentum overseas. Now, turning to commodities, gold ended up gaining $5 on the week, which was okay, but not as good as some of the other commodities. But it is encouraging that it's been able to hold the recent gains. But more importantly for me, gold stocks globally outperformed both gold and the S&P 500 index, and that's quite telling. And we'll have a look at some particular charts highlighting that in just a minute. Silver was also 1% higher, so it is still outpacing gold, and that's really the third key indicator that we're really building up towards a breakout and a new bull market in gold stocks. We've got gold stocks outperforming gold, the S&P, and silver outperforming both of them. So they're all the really positive signs that you need to see. Copper gained ground to $3.25 on continued increasing optimism about world economic growth. And crude oil backed off a little bit down to 104. I think a little bit of the Middle East tension has got out of the headlines, and so oil eased back just a little bit. So let's have a look at those charts. We'll start with a weekly chart of gold. So you can see we're still in this phase 1 base on a big picture level, and we're sitting about in the middle of that phase 1 base. So gold still has quite a bit of work to do to break into that new bull market, but that could all happen fairly quickly. If we look at silver, this is on a daily chart, also still within the phase 1 base, but you can see has been really quite strong over the last 3 or 4 weeks. Turning to the GDX index, also still within its phase 1 base, so very similar to gold, but certainly starting to look better. That was a really robust 3 or 4 weeks that we've had there. And if you look at the junior gold miners index, even more positive. So some really positive signs around gold stocks. Let's have a look at some of the spread charts just to give you a bit of an idea. The first one is the value of the GDX index divided by the price of gold. So as you can see, for a long period of time now, that spread line has been falling quite dramatically. That means that gold stocks have been doing worse than the price of gold. So gold stocks have been going down faster than the price of gold has been going down. Now that process stopped around about November of last year. So we've now been in this phase 1 basing pattern that's been running now for about 8 months. And as you can see, we're getting back towards the highs of that consolidation. So the signs certainly looking better that gold stocks have stopped declining faster, and certainly in the last couple of weeks, they've been going up more quickly than gold has. The other interesting one to look at is the S&P 500 index divided by the GDX. And again, it's the mirror image of what we just looked at before. You can see for a long period of time, stocks in the S&P 500 were doing better than gold stocks, but that has been consolidating in a topping pattern. Again, that started around about January, so it's been running now for 6 months, and certainly over the last few weeks you can see that gold stocks have now started significantly outperforming the S&P 500 index as a whole. So good signs. I believe that we will see a clear and well-defined breakout in gold stocks and gold prior to the end of this year. Now, this is the spot copper chart. You can see that from the lows under $3, which was in March, when everyone was pretty fearful about a lot of things, including China and Europe, that there's been quite a big recovery, and we're back up now to $3.25. So good signs there for copper. Now, strategically, This is the same slide I showed last week, but I just want to keep reinforcing the message. Members are getting this message loud and clear every day, but non-members, if you're not getting this message, then this is the most important thing that I could put in front of you. You really need to be thinking about trading and investing on a global basis. It's where the guaranteed drivers are. Now I put guaranteed in inverted commas. Nothing, of course, is absolutely guaranteed, but areas like the shale gas and oil revolution, like all of the forms of new digital technology, biotechnology, the emergence of terrific value back into some of the non-American stock markets around the world. The drivers behind those markets do look extremely powerful. I recommend that you stay with the strongest trends. There are still great sector moves in America. Yes, there are some stocks that are overvalued and I wouldn't touch them, but there are still some terrific sector moves and you can still get great value in America if you know where to look. Also emerging markets in Europe, Asia, and other countries are providing terrific value. And there's also so many aspects to new technology which is just mind-blowing advances that are going to create fantastic trading and investing opportunities, or are creating them now. Again, you just need to be organized. You just need to know where to look and have a game plan to take advantage of it. So a message for certainly for members of Specialist Share, but also for non-members. Well, for non-members, you certainly have the opportunity to join our group, and I'll help you to trade and invest overseas. If you don't wish to actually do it yourself for various reasons of time or whatever it may be, then I have a facility where I can do that for you. So if you would like more information about that, then there's my email address specifically, and also you'll find some information on our website as well. So that's it for this week. Cheers.